All right, we have more changes unfolding in the U.S. economy and in the world of commercial lending. Changes that have small and mid-sized companies scrambling to remain in business as tens of thousands of small business owners have loans beginning to mature come 2024. They've begun talking to their banks and they have found out that they are out of luck, searching for a lender that will write them a loan with fair terms, and they're unable to find one. And be clear, this is about small and mid-sized companies, mom and pops, not big corporations, as many of these banks have put minimum thresholds in place for corporate loans, 30 million, 50 million, anything under that, and they are out. This is something that we've been talking about since last year, and it's happening. We have the numbers, we have the testimony or the anecdotal stories from these business owners who are finding themselves stuck between a rock and a hard place. Well, just wait till you hear what they're going through, because we have the video. It's pretty astonishing how difficult it is right now. These are real people, folks, real jobs on the line. So we're going to look at what's happening, how bad it could be, what these people are saying that they're dealing with right now. You'll hear it in their own words, and what kind of impact it could have next year. Could it push us into a 2024 recession or cause a spike in unemployment? Well, we're going to look at that, all of that. But before we get started, press the like button and consider subscribing. It helps the channel out. Also, if you want regular updates, check out our daily show over on the Notify America YouTube channel. The link is in the description. So lag time, folks. How long it takes before the Federal Reserve's tightening campaign reaches the lives and livelihoods of regular, hardworking Americans. Well, it looks like that time is here. That time is now, as reports have begun surfacing that loans are becoming next to impossible to find. These are corporate loans, financing that small businesses, mid-sized businesses need to continue operating. The vast majority of businesses require some form of financing to stay open. They depend on it. They use their credit lines to purchase like store inventory or to afford supplies that they need to start a project with that they're hired for. All sorts of reasons and use cases. It's actually rare to find a business who doesn't rely on some type of financing in some form or fashion. And something that we've been talking about, harping on for over a year now, is how the Fed's current policies are forcing banks to tighten their lending standards. We used to talk about it all the time. Make it more difficult to obtain a loan, shrink the available pool of easy money. You could see it here. This is how much tighter it's gotten over the last 18 months. The higher this line goes, the more lenders are restricting access to capital. This line is quarter over quarter, by the way. So even though it dropped in October for Q3, doesn't necessarily mean that they loosened policy. It just means that the rate to which they were tightening month over month or quarter over quarter slowed way down. Look, the United States is a debt-based economy, folks. Everything runs on debt in this country, in most countries really, but the U.S. is like the king of debt. We love our banks, we love our credit cards, our mortgages, our second mortgages. Hell, why not even a third mortgage, right? Between 2020 through 2021, there was this explosion in lending. Debt shops and lending houses were in a frenzy as people and businesses were looking to take advantage of the free money that banks were handing out. Real interest rates were negative. That's right, the real yield went negative. The interest rate that actually matters, how much it costs to really borrow money, that means like the return on interest after inflation was negative. Well, all of those loans, all that free money is coming due. Literally, the loans are maturing. $230 billion in corporate loan maturities in 2023 as of October. So the pain began in October, or began in 2023 rather, but look what happens tomorrow. Look what begins in 2024. Corporate loan maturities more than double. Actually, it's around 3x the number of loans maturing next year, as we saw in 2023 this year, $790 billion worth, and it continues ramping up. So if you're a business owner and you were unlucky enough to be in this situation, you are scrambling right now to, number one, find a bank who will write you a new loan after the current one matures, and number two, try to do so ASAP while interest rates are still under 6%, as many of these people are facing interest costs to service these new loans that will be like 3 to 4 points higher than what they're currently paying. Watch this.
We're recovering really well. We'll be within probably 30% of pre-pandemic numbers by the end of the year. So the business is doing well. The business is healthy, great reputation. And yet nobody will give me a loan on the building. And the one person that did make me the loan offer, the rate was so high and the terms were so bad. I mean, I was grateful to get the offer, but I would be out of business in 6-7 months because the interest is so high. It's an interest-only loan, and my payments would more than double, almost triple from what they are now. And so it would take, well, right now I'm doing what, $800,000 a year in revenue, and it would take most of that revenue just to make the building payments. I wouldn't be able to pay my staff, my vendors, anything. So, if the interest rates are high, nobody wants to make a reasonable loan, despite the fact that I have impeccable credit and a really good business and a lot of equity in the building. But it's like they don't care about those things that they've always cared about anymore. So I'm a little bit lost as to what to do, and I'm running out of time.
Now, Mark, a lot of people are in the same shoes as you
Oh,
are.
yeah.
There's
Worse, I'm sure.
$2 billion of loans coming due this year, and then there's another $2 billion that they need to get refinanced next year in San Francisco.
Yeah.
The Epoch Times just interviewed a number of small businesses in San Francisco, for example. Check this out. Look how bad this is. They write, San Francisco small business owners calling for help. They write this, a longtime small business owner in San Francisco is on the verge of losing his business because he says no bank will make him a commercial loan, a corporate loan. Marquis Sackett, who owns the Box San Francisco, that's the guy that we just watched, his business is a meeting and event space in a historic building in the city's south of Market District, said a loan on his business is due in February, but dozens of lenders are turning him down. 6 have said they are not even willing to make a commercial loan in San Francisco. Others have told him that they won't make a loan for less than $30 million, while another made him an offer, but under poor terms. Look, if you've been watching this channel for a while, we've talked about all of this for a long time, how tighter lending standards don't only restrict capital by writing less loans, but the banks also change the terms of their loans, making it more favorable for themselves. Realize why this is happening, right? Lenders, the banks, are trying to shore up their balance sheets as it's not just more expensive for the borrower, but it's more expensive for the bank as well. That's how our system works. The Fed's been trying to burn all the extra dollars that made their way into the system over the pandemic years. And one way to do that is to put the brakes on, put the banks in a position to slow the creation of new money. As new money is created when banks write new loans, the less loans being written, the less new money being created. They go on and say this. He says he has impeccable credit and kept his business with 2 employees afloat during the pandemic by dipping into his retirement savings. After many, he said, called it quits. Now starting to finally recover from the pandemic, he said his business has picked back up, which keeps hundreds of vendors employed, like caterers, florists, bartenders, and tech teams. I'm a blip on the radar, he said, but I would argue that I am a critical part of the economy for those hundreds of others that I help stay employed. This is what happens, folks. There's this ripple effect to this type of thing. It's not just a single business that goes under. A lot of times a single business has tentacles that reach hundreds, sometimes thousands of other businesses. Think about it. I own a software company. I charge per seat for my software. I have thousands of single user customers who only have one person, one seat, one license, who need to use the CRM. But I also have customers who pay for hundreds of seats. Some customers have hundreds of employees and each employee needs to use the CRM. But then I have a couple customers who are like the anchors of our company who pay for thousands of seats. A single company who has 1,200 seats, that's a whole lot of revenue. So what happens if that one company were to go out of business? Well, it obviously affects their business. The thousands of employees are now, without work. They're out of a job, but it also affects me. My business now loses that giant account. And I'm only one of the suction cups on that one tentacle in the reach that business may have. Do you see what I mean? So it's like a domino effect. As these loans begin to mature and businesses begin to go belly up, it's not just those businesses that are affected. The pain spreads quickly. The economy quickly begins to shrink. So could that be what happened 2 weeks ago? Is that why Jerome Powell said what he said at the last FOMC meeting? It's a theory, it's speculation, but I wouldn't be surprised if he's throwing a lifeline to the tens of thousands of businesses and real estate investors whose loans are getting ready to reset next week, next month. As him saying what he did just saved them a whole ton of money. Interest rates fell almost 150 points last month. If you're a business, whether you're in a commercial real estate or you have a corporate loan that's coming due, the interest expense on your new loan won't be 4 points higher anymore. Now it'll only be 2.5 points higher because of what Jay Powell said at that press conference, possibly saving a big chunk of the companies who were getting ready to file bankruptcy. All right, that wraps up this video. If you enjoyed it, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.